Hello students, lecture 1 from admission of a partner topic. In lecture 1 video, I am going to explain about third problem from admission of a partner topic. I am taking this question from Telangana State Inter Second Year Telugu Academy Accountancy Textbook. But this video is useful to all commerce students who want to know about admission of a partner topic. This question is available in the description box. On admission of a partner topic, I made 5 videos. Part 1 to Part 5. Video links also I am giving in the description box. Before explaining the problem, let me clear one doubt. In lecture 1, I have to explain about problem number 1. No? Directly from problem number 3, I am starting admission of partner series. Why? Because in case of admission of a partner, goodwill adjustment is one important adjustment. To adjust goodwill, there are 3 methods: premium method, revaluation method, memorandum revaluation method. Under premium method, again we have 3 methods. First one is goodwill paid privately. Second one, new partner brings goodwill and that amount will be retained in the business. Third one, new partner brings goodwill, that goodwill will be withdrawn by the old partners. So total 5 methods we have. Under premium method 3 methods and revaluation method, memorandum revaluation method. So method wise if I explain the problems, then clearly you will understand this goodwill adjustment. In present video, I am going to explain about premium method, first method. In that again 3 sub methods are there now. Under them first one, that is goodwill paid privately. Therefore, I am starting lecture 1 with the third problem. Let us see the question first. Third problem, Naresh and Ramesh are partners in a firm sharing profits and losses in the ratio of 2:1. Their balance sheet as on 31st March 2019 was as under. This is balance sheet. Liabilities amount, assets amount. Under liability side, he has given creditors 15,000, bills payable 20,000, general reserve 21,000. Capitals of Naresh and Ramesh are 60,000 and 30,000 respectively. Under asset side, cash at bank 6,000 rupees, bills receivables 10,000 rupees, debtors in inner column 21,000 rupees, minus provision for bad debt 1,000, in outer column 20,000. Stock 30,000, investments 35,000, machinery 45,000 rupees. Two sides totals are 1,46,000 rupees. Below the balance sheet, he has given some additional information. On 1st April 2019, Suresh was admitted into partnership. The terms of admission are: A. Suresh should bring 30,000 as his capital. B. Stock be depreciated by 5%. C. Machinery valued at 50,000 rupees. D. Provide for bad debts at the rate of 8% on debtors. E. Bills payable need not be paid 2,000 rupees. F. Suresh should pay 15,000 rupees to Naresh and Ramesh as goodwill privately. What he is asking in the question? Give journal entries, necessary ledger accounts and balance sheet of new firm. Observe the old balance sheet date 31st March 2019. Naresh and Ramesh started their partnership business with one agreement. Up to 31st March 2019, these 2 members only handled this business. At the end of accounting period, on 31st March 19, they prepared one balance sheet. This balance sheet contains the details of Naresh and Ramesh as per their agreement. On 1st April 2019, they are going to admit Suresh as a new partner. Now, Suresh is known as new partner, Naresh, Ramesh are known as old partners. When new partner is coming into the firm, this old partnership agreement will automatically get cancelled because that agreement contains the terms and conditions of only Naresh and Ramesh. Now Suresh is also admitted in the business now. Therefore, these partners have to cancel that old agreement. In the lieu of that agreement, they have to prepare a new partnership agreement. which contains the details of Suresh also. So the cancellation of old partnership agreement and preparation of new partnership agreement is known as dissolution of partnership or reconstitution of partnership. In the event of dissolution of partnership, old partners have to do some adjustments in accounts. By considering these adjustments, in the place of this balance sheet, they have to prepare another balance sheet on the same day, which contains the details of three partners. So, this is the balance sheet of Naresh and Ramesh. This is the balance sheet of Naresh, Ramesh and Suresh. This is old balance sheet which is given in the question, and this balance sheet we have to prepare as a solution. This is new balance sheet. Directly new balance sheet we cannot prepare. For preparation of this balance sheet, we need the help of these three accounts: revaluation account, capital accounts of three partners, cash account or bank account. Accounts we prepare in ledger book now, means to prepare balance sheet we have to prepare ledger. So in ledger we post journal entries, means before the preparation of ledger we have to pass some journal entries in journal book. So as a solution for third problem, what we supposed to do now? Journal entries we have to write, then in ledger book these three accounts we have to prepare. After that we have to prepare the balance sheet which contains the details of all partners. In question he has given old balance sheet and some additional information. By considering the additional information, this old balance sheet we have to readjust and we should prepare this new balance sheet. Observe the sentence: give journal entries, necessary ledger accounts and balance sheet of new firm. First we have to prepare journal entries. This is journal. In present problem, 1, 2, 3, 4, 5. Total 5 entries come. After journal entries, we have to prepare necessary ledger accounts now. In ledger, first you have to prepare revaluation account. This is revaluation account. After revaluation account, we have to prepare capital accounts of all the three partners in this manner. Bank account. Finally, he is asking us to prepare balance sheet of new firm. This is balance sheet. Actually speaking, first all journal entries we should write. After that, one by one accounts we have to open and those journal entries we have to post in the accounts now. But if I explain in that manner, you cannot understand the journal entries. So what I will do is accounts and the journal entries. Simultaneously I will explain to you. Let us start with the first account, revaluation account. Adjustment number B, C, D and E. These 4 points are related with revaluation account. B. Stock be depreciated by 5%. C. Machinery valued at 50,000 rupees. D. Provide for bad debts at the rate of 8% on debtors. E. Bills payable need not be paid 2,000 rupees. See the B point? Stock be depreciated by 5% rupees. In old balance sheet, stock value is given as 30,000 rupees. And in adjustment, he is saying that stock be depreciated by 5%. By saying this sentence, you may think that final accounts related depreciation adjustment he has given in the question. Recollect final accounts lesson? In question, he gives trial balance, adjustments, and in solution, we have to prepare trading account, profit and loss account, and balance sheet now. Suppose in question he has given stock value as 30,000 rupees. In adjustments, he is saying that stock be depreciated by 5%. Stock means the article with which we do business, the article which we are going to sell to the public. Stock is also known as inventory or goods. You may think that as we are using that asset continuously, its value reduces. It is called depreciation. Depreciation is a loss to the firm. As per nominal account rule, debit all expenses and losses, credit all incomes and gains. Profit and loss account is a nominal account now. Therefore, debit side we should show depreciation on stock. How we calculate depreciation? Asset value into depreciation percentage. Then 1500 is to be debited to profit and loss account. And in balance sheet, under asset side, depreciation is to be deducted from asset value. Then the net asset value should be shown in amount column. But the depreciation adjustment in final accounts and the depreciation adjustment in admission of a partner topic, these two are totally different. First, you observe one point. Depreciation always we provide on fixed assets. Assets are of two types now: current assets, fixed assets. Current asset means an asset which is used for a short period. Here short period means within 1 year. And if any asset is used for a long period, it is known as fixed asset. Stock, goods, regularly we sell to the customers. So goods are used only for a short period. Goods come under current asset. And current asset value fluctuates. Today in our organization, goods value is 30,000. Tomorrow it may be 40,000 because more 10,000 worth of goods firm may purchase. Day after tomorrow it may be 20,000 because firm sells some goods to the customers. But fixed assets, they are used for a long period and slowly their value reduces. Therefore, every year we have to provide depreciation on fixed assets. Stock is not a fixed asset. It is current asset. On current assets, we should not provide any depreciation. So remove this final accounts related depreciation adjustment from your mind. Let us see the meaning of this sentence in case of admission of a partner. On 31st March 2019, stock value is 30,000 rupees. You know, accounts are prepared under historical cost method. Means assets and liabilities are recorded at their book prices. As long as business is continued by Naresh and Ramesh, they can show all assets and liabilities at their book values. Because if market price is different from these book values, the profit or loss due to these differences between market prices and the book values belong to only these two members. But when a new partner is coming into the firm, instead of showing historical values in balance sheet, old partners have to show the market values. And the profit or loss which arises due to the differences between market values and historical values belong to old partners only. Take this stock example. Here, stock is shown as 30,000 rupees on 31st March 2019. As new partner is coming on 1st April 2019, they have to show the market prices of assets and liabilities in balance sheet now. So these two members observed the market price of stock on 31st March 2019 and they came to know that stock market price is not 30,000, it is 28,500 rupees only. So market value of stock is reduced by 5%. That is the meaning of provide depreciation 5% on stock. Don't think that stock continuously we used, stock is damaged, that depreciation he is asking in the question. How you have to understand this sentence? Market price of stock is reduced by 5% when they revalue this asset. One asset value is reduced. How much? 30,000 rupees minus 28,500 is equal 1500 rupees. If 1500 worth asset is reduced, that 1500 is a loss. Who should bear that loss? Only old partners. Because this loss is erased before the admission of Suresh. Suresh is not concerned with the 1500 rupees loss now. So, at the time of admission of partner, If any asset value reduces, it is a loss, and that loss is to be paid by old partners only. C point is machinery valued at 50,000 rupees. In old balance sheet, machinery value is given as 45,000 rupees. On 31st March 2019, machinery value is 45,000 rupees. This is book value of the machine. As new partner is coming into the firm, on this date, partners want to show the market values in the balance sheet. So they inquired in the market and they came to know that on 31st March 2019, machinery market price is 50,000 rupees. So in books, they are writing that machinery value is 45,000. But on that day, in outside market, machinery value is 50,000. Machinery is an asset and asset value increased. This is profit. Profit amount is 50,000 rupees minus 45,000, 5,000 rupees. Now who should take this profit? Only old partners, because this profit is generated before the admission of new partner. D point. Provide for bad debts at the rate of 8% on debtors. See the old balance sheet. Debtors value is given as 21,000 rupees in inner column minus provision for bad debt 1,000 rupee in outer column 20,000 rupees. And in adjustments, again he is giving that we have to provide depreciation on debtors at the rate of 8%. On 31st March 2019, debtors value is 21,000 rupees. And the partners are suspecting that 1,000 rupees of 21,000 may not come. So with 1,000 rupees, they provided a provision for bad debts. And they are showing that debtors value is 20,000 rupees. 20,000 rupees will come from debtors. As new partner is coming on this date, partners revalued these debtors. Again, they expected provision for bad debt. And they are estimating that provision for bad debt amount is not 1,000 rupees, it is 1680 rupees. Means 680 extra may not come from the debtors. So this is 680 is loss. Who should bear this loss? This is a provision for bad debt loss arised before the admission of new partner now. Therefore, only old partner should bear this extra loss of 680 rupees. E adjustment, bills payable need not be paid 2,000 rupees. See the old balance sheet? Bills payable value is given as 20,000 rupees. And in adjustments he is saying that out of this 20,000, 2,000 we need not to pay. On 31st March 2019, bills payable liability value is 20,000 rupees. As new partner is coming into the firm, old partners evaluated this liability. They revalued this liability and they came to know that out of 20,000 rupees, 2,000 they need not to pay. So 2,000 may be a discount. Then final liability amount is 18,000 rupees only. Here liability is reduced by 2,000 rupees. If asset is reduced, it is a loss. If liability reduces, it is a profit. That profit belongs to whom? Only old partners, because this profit is generated before the admission of new partner. So remember, when new partner is admitted in the business, at the time of his admission, old partners have to revalue the assets and liabilities. Means they have to compare the historical values of assets and liabilities which they are writing in accounts books with their market values. Suppose asset market value is more than its historical cost. Means asset value increased, it is a profit. If asset value decreases, in other words, if assets market price is less than the historical cost, it is a loss. If liability value increases, means in books we wrote that creditors amount is 50,000. But in our revaluation, we came to know that we forgot to consider more 10,000 rupees. Now creditors value became 60,000 rupees. Extra 10,000 is increased now, that is loss. So if liability value increases, it is a loss. If liability value decreases, it is profit. So in revaluation of assets and liabilities, they may be profit or loss. This profit or loss should belong to old partners only. If there is any profit in revaluation of assets and liabilities, that should be taken by old partners. If there is any loss in revaluation of assets and liabilities, that loss is to be borne by old partners. So to know the profit or loss in revaluation of assets and liabilities, old partners prepare revaluation account. In ledger book, first account is revaluation account. Revaluation account is a nominal account. So while preparing this account, nominal account rules we have to follow. What is nominal account double entry principle? Debit all expenses and losses, credit all incomes and gains. When loss comes in revaluation of asset and liability, if asset value is decreasing or liability value is increasing, then loss comes. When profit comes in revaluation of asset and liability, if asset value is increasing or liability value is decreasing, then profit comes. First adjustment is given on stock, no? In old balance sheet, stock value is 30,000 rupees, and in additional information, he is asking us to provide 5% depreciation on stock. What is the meaning of that? Comparing to the book value of stock, market price is reduced by 5%. So when asset value is decreasing, it is a loss. Therefore, the depreciation on stock we have to show on debit side of revaluation account. To stock account, in bracket show the calculation. Stock value is given as 30,000 rupees in old balance sheet. On that, 5% depreciation we have to provide. Stock market price is reduced by 1500 rupees. It is a loss. Next adjustment is about machinery. In old balance sheet, machinery value is given as 45,000 rupees. And an additional information is giving that machinery is revalued at 50,000 rupees. So comparing to book value, machinery market price is increased by 5,000 rupees. Asset value is increasing. So that 5,000 is profit to us. Therefore, credit side we have to show that by machinery account. How that 5,000 is coming? Market price 50,000 minus book value. The value which is given in old balance sheet is 45,000 rupees. 5,000. Next is about debtors. In old balance sheet, debtors value is given as 21,000 rupees and he deducted 1,000 rupees provision for bad debts from debtors. In adjustments, he is giving that at the time of revaluation, old partners want to provide 8% provision for bad debts on debtors. So 8% on 21,000 will be 1680. In that 1680, in old balance sheet, already they have provided 1,000 rupees as PBD. Now at the time of revaluation, extra PBD is 680. So when you provide this extra PBD, debtor value decreases, no? Because PBD we deduct from debtors. So as debtor is an asset and its value is decreasing, we have to show that PBD on debit side of this account. 2. Provision for bad debts. Show the amount clearly. 21,000 is given in the old balance sheet. On that, 8% provision for bad debts we have to provide. Total provision for bad debt should be 1680. Out of this 1680, in old balance sheet, already they have provided 1,000 rupees provision for bad debt. So at the time of revaluation, how much more PBD we should provide? 680 rupees. How that 680 comes? 1680 minus 1000 rupees. This 680 you have to show in amount column. Next one is about bills payable. In old balance sheet, bills payable is given as 20,000 rupees under liabilities. And in additional information, he has given that out of this 20,000 rupees, 2,000 we need not to pay. So what happened here? Liability value is decreased by 2,000 rupees. This 2,000 is profit to the firm. Therefore, credit side we have to show that by bills payable. We need not to calculate anything. Directly amount is given in the question. 2,000 is reduced liability value. So that 2,000 is profit. In amount column directly we can write 2,000 rupees. Related to revaluation account, all adjustments were taken here. Finally, we have to calculate the profit or loss in revaluation of these assets and liabilities. Procedure is, observe which side amount column total is more. Credit side amount column total is more. In rough notes, write down the total first. Credit total is 7,000 rupees minus debit side amount column total. Difference is 4,820 rupees. Credit side we wrote profits. Debit side we wrote losses. Profit is more than the loss. Therefore, this answer is profit. So, in revaluation of assets and liabilities, there is a profit of 4,820 rupees. As this profit is erased before the admission of new partner, this profit belongs to only old partners. So, how we have to distribute to them? Directly, we are not going to pay in cash form. We transfer this amount to old partners' capital accounts according to old profit and loss ratio. Which side we have to show this calculation? Debit total is less than credit total now. Therefore, debit side we have to transfer this profit to old partners' capital accounts. So we should write to Naresh capital account, to Ramesh capital account. Profit 4,820 rupees we should distribute to these two members. In which ratio? In 2:1 ratio. Because in question he has given that Naresh and Ramesh are sharing profits and losses in the ratio of 2:1. Here Naresh and Ramesh. So 2 number belongs to Naresh and this 1 number belongs to Ramesh. Naresh sharing profits is 2 by, add these two numbers, 2 plus 1, 3. And Ramesh sharing profits is 1 by 3. Okay? Means what? 2/3 of 4,820 we should transfer to Naresh capital account. 1/3 of 4,820 we should transfer to Ramesh capital account. Let us do that calculation. 2/3 of 4,820. How you will get that? You have to multiply this fraction with 4,820. Similarly, 1/3 of 4,820 means we have to multiply 1/3 with this number. I'll show this calculation separately. 4,820 we have to divide with 3. 3 ones are 3. 1. Bring this 8 here. 3 6 are 18. Now 2 is less than 3. So directly we cannot bring 2. Before bringing this value, put one 0 here. Then take this 2 here. Bring 0 also. Then again 3 6 are 18. 2. Put one point here. Add one 0. Then again 3 6 are 18. It continues like that. So after point 6 number only comes. We can stop here. So this value into 2 now. Into 2. 3,213.2. After point 2 is there. After point, if the number is below 5, means 0.1, 0.2, 0.3, 0.4, then while taking the round-up value, you can ignore this value. So 3213 is the share of Naresh in revaluation profit. So 3213, you have to write here. 4820 into 1 by 3. So we have the answer here. 1606.6. After point, the digit is more than 5. So how to take the round-up value? We can add one number here. So instead of 6, you have to take 7. So 1607. Cross check is, if you add these two numbers, again this number should come. Then only your calculation is correct. Now two sides put the totals. As we have written the difference amount on debit side, if you total these amounts, you will get 7,000 rupees. Credit total already we have calculated here, 7,000 rupees. So this is all about revaluation account, first account. Let us frame the journal entries with the help of this revaluation account. In revaluation account debit side, we wrote two losses. Stock value is reduced, asset is reduced, it is one loss. Debtor value is reduced, it is one loss. For this loss, we should write the first entry. In revaluation account debit side, we posted two stock, two provision for bad debts. If you want to post like that, in journal entry also, revaluation account should be debited and stock account, provision for bad debts account are to be credited. Revaluation account data, to stock account, to provision for bad debts account. As entry contains more than two accounts, this entry is known as compound entry. In case of compound entry, how to write the amounts? As two accounts are credited, first credit amount column we have to fill. Stock is 1500 rupees. Provision for bad debt amount is 680 rupees. Add these two amounts and total 2180 rupees in debit column we have to write. What is the narration for this? What happened here? There are two assets. Assets value decreased. For that we wrote this entry, no? So mention that in the narration. Being the entry for loss in revaluation of assets. So asset value decreased. It is a loss. For that loss, we wrote this entry. Next, come to credit side of revaluation account. We have one asset increase. Machinery value is increased. Profit. Liability value, bills payable value decreased. This is also one profit. For this profit, we should write the second entry. How to frame that entry? In revaluation account, if you want to post this on credit side, in journal entry also, revaluation account should be credited and we should debit machinery account, bills payables account. Then the second entry is machinery account debtor, bills payable account debtor to revaluation account. This is second entry, machinery account debtor, bills payable account debtor to revaluation account. As two accounts are debited, in debit column, first we have to write the amounts. Machinery is increased by 5,000 rupees. So write down 5,000. Bills payable is decreased by 2,000 rupees. Add these two amounts and for revaluation account, in credit column write down the total 7,000 rupees. And what is the narration? Observe what happened here. One asset value is increased, one liability value is decreased. These two are profits in revaluation of asset and liability. So mention that being the entry for profit in revaluation of asset and liability. Machinery is asset here, bills payable is liability. Third entry is for transferring the revaluation of assets and liabilities profit to old partners' capital accounts. In revaluation account debit side, we wrote these two capital amounts. If you want to post like this, in journal entry also, revaluation account should be debited, Naresh capital, Ramesh capital should be credited. So the entry is revaluation account debtor to Naresh capital, to Ramesh capital. This is third entry. Revaluation account debtor to Naresh capital account to Ramesh capital account. In revaluation of assets and liabilities, there is a final profit of 4,820. In this 4,820 rupees, Naresh share 3,213 rupees we are transferring to Naresh capital account. Ramesh share 1,607 rupees we are transferring to Ramesh capital account. For that we are writing this entry. Narration. In revaluation of assets and liabilities, finally there is a profit. This profit we are transferring to old partners in old profit and loss ratio. Mention that in narration. Being the profit in revaluation of assets and liabilities is transferred to partners' capital accounts in old profit and loss ratio. So remember, related with the revaluation account, in journal we have to write 3 entries. For revaluation loss, first entry. For revaluation profit, second entry. For the transfer of revaluation profit or loss to old partners' capital accounts, third entry. After revaluation account, we have to prepare capital accounts. Capital accounts of Naresh, Ramesh and Suresh. Instead of writing owner's name, we write capital word now. Owner's name is a personal account. Therefore, capital account is also a personal account. Capital word represents owner's name. So, capital account is known as representative personal account. While preparing capital accounts, we have to follow personal account rule. What is personal account double entry principle? Debit the receiver, credit the giver. Means if any partner is receiving some benefit from the firm, we should write that amount on debit side of capital accounts. Same point in another manner I will explain. As partner is receiving benefit from the firm, if partner is retiring from the firm, then partner should return that benefit to the firm. So debit side which amounts we should write? At the time of retirement, the amounts which partner has to return to the firm, we should write on debit side. Similarly, credit the giver means if partner is giving some benefit to the firm, the transaction credit side of capital account we should post. Same point I will explain in another manner. As partner has given that benefit to the firm, if partner is retiring, firm should return that benefit to the partner. So at the time of retirement, the amounts which firm should return to partner, we should show on credit side of capital accounts. If you remember these 2 hints, then preparation of capital accounts become easy. Capital accounts we have to start with opening capital balances. From where you have to take these amounts? See the old balance sheet liability side. Under capitals heading, he has given that Naresh capital is 60,000 rupees, Ramesh capital is 30,000 rupees. So with these 2 amounts, we have to start capital accounts. Opening balances we have to show on credit side of capital accounts by balance brought down. In Naresh column 60,000 rupees, in Ramesh column 30,000 rupees. In old balance sheet, Suresh capital amount is not available. So in Suresh column, we should not write any amount. Now the doubt is, why we are showing opening balance of capital on credit side of capital accounts? Because capital account is a liability. Liability shows a credit balance. Therefore, on credit side, we have to bring the opening balance. Next, we have to write the revaluation profit. Recollect the third entry. Revaluation account debtor to Naresh capital account to Ramesh capital account. Now we are preparing capital accounts now. We have to observe whether capital accounts are debited or credited. As capital accounts are credited, this entry comes on credit side of capital account. What to write in particulars column? Other side account name. On other side, debit side, we wrote revaluation account now. Write down that in particulars column. And in Naresh column, 3,213 rupees we should write. And in Ramesh column, 1,607 rupees we should write. By revaluation account, Naresh share 3,213 rupees. Ramesh share 1607 rupees. For Suresh, don't write anything. Next one is accumulated profit. You have to observe in balance sheet under liability side whether general reserve is given in the question or not. In present problem, general reserve amount is given in the question. So accumulated profit adjustment we should do. When Naresh and Ramesh are running partnership business, every year they may earn some profit. Actually speaking, partners should withdraw that profit amount. But if they withdraw entire amount from the business, firm cannot meet unexpected expenses. So for contingent liabilities, to meet unexpected expenses, partners keep some profit amount in the firm itself. And with that amount, partners may create one journal reserve. So this journal reserve is known as accumulated profit. Accumulating means what? Undistributing. So instead of distributing that profit to old partners, that profit amount is kept in the business. If only these two partners are there, then we can keep that amount in the firm itself. No problem. But on 1st April 2019, as Suresh is coming as a new partner, before his admission, old partner should take that general reserve amount. They need not to take that in cash form. By transferring this general reserve to their capital accounts, we have to distribute this undistributed profit to partners' capital accounts. In which ratio? In old ratio. What is the entry for that? One should recollect the third entry. Revaluation account data to Naresh capital account to Ramesh capital account. This is the entry to transfer the profit in revaluation of assets and liabilities to old partners' capital accounts. We have debited revaluation account. In the same manner, if you want to transfer general reserve to old partners' capital accounts, we should debit general reserve account. General reserve account data to Naresh capital to Ramesh capital. In old balance sheet, general reserve amount is given as 21,000 rupees now. This 21,000 we should distribute to old partners as per old profit and loss ratio. Old profit and loss ratio is 2:1. Means Naresh share is 2/3, Ramesh share is 1/3. 7,000 into 2, 14,000 rupees. Ramesh share is 7,000 rupees. So in 21,000 rupees, 14,000 belongs to Naresh and 7,000 rupees belongs to Ramesh. Why general reserve account is debited in this entry? General reserve is given under liability side. Liability shows a credit balance. Now, by transferring general reserve amount to Naresh capital and Ramesh capital, we are going to close this general reserve account. It shows a credit balance. If you want to close that account, we have to debit that account. And why capital accounts are credited? Capitals come under liability side now. As per business entity concept, owner is separate, firm is separate. So when owner brings capital into the firm, our assumption is from outsider we are taking loan. So capital is also a liability. To old partners' capital accounts, we are adding their share in general reserve. So capital amount increases. Capital is a liability. Liability shows a credit balance and we want to increase that liability amount. Therefore, again we have to credit capital accounts. This is fourth entry. General reserve account data to Naresh capital to Ramesh capital. General reserve amount is 21,000 rupees. In this 21,000, 2/3, that is 14,000 rupees, we are transferring to Naresh capital account, and 1/3 of 21,000 rupees, that is 7,000 rupees, we are transferring to Ramesh capital account. Narration. General reserve amount we are transferring to old partners capital accounts in old profit and loss ratio. That you have to mention in the narration. being general reserve is transferred to partners' capital accounts in old profit and loss ratio. Now capital accounts we are preparing now. Observe capital accounts are debited or credited. In journal entry capital accounts are credited. Therefore this entry appears on credit side of capital accounts. And what to write in particulars column? Other side, debit side, we wrote journal reserve now. Write down that account name. And in Naresh amount column, we have to write 14,000 rupees. In Ramesh amount column, we have to write 7,000 rupees. By general reserve account, in Naresh column 14,000 rupees, in Ramesh column 7,000 rupees. For new partner, don't write any amount. Adjustment number F is related with goodwill. Suresh should pay 15,000 rupees to Naresh and Ramesh as goodwill privately. Let us know some important points related with goodwill. Assume in 2011, Naresh and Ramesh started one partnership business. With their complete efforts, with great hard work, they developed this business. In 2020, by investing 10 lakh rupees, they are able to earn a profit of 4 lakh rupees. On the other hand, with that same capital, outside firms are able to earn a profit of 2,50,000 rupees in an average. So when others are earning 2,50,000 rupees with 10 lakh rupees capital, they are able to earn a profit of 4 lakh rupees with the same amount. Means 4 lakh rupees minus 2,50,000, 1,50,000 rupees extra they are able to earn. This 1,50,000 rupees known as super profit. Why they are able to earn super profits? Because they have some reputation in the market. They have their permanent customers. So they are able to make more sales. They are able to earn more profit. Just like other assets, machinery, land, building, they can show goodwill also as their asset. So goodwill is one intangible asset. Which firms can show goodwill as their asset? The firms which can earn super profits can show goodwill as an asset. Assume that Naresh and Ramesh are sharing profits and losses in 1:1 ratio, and every year they are able to earn an average profit of 60,000 rupees. Then out of the 60,000, Naresh's share is 60,000 into 1 by 2 is equal to 30,000, and Ramesh's share is 60,000 into 1 by 2, 30,000 rupees. On 1st April 2019, after this date, they are taking Suresh as a new partner. As Suresh is admitted, suddenly profit doesn't increase. Profit amount will be same. But now instead of making it 2 parts, they have to make it 3 parts. Because 3 partners are there. Assume that their new profit and loss ratio is 1:1:1. In that case, Naresh gets 1/3 of 60,000 rupees, 20,000. Ramesh also gets 20,000 rupees. Suresh share is also 1/3 now, therefore 20,000 rupees. So, before Suresh admission, Naresh used to earn a profit of 30,000 rupees. Ramesh used to earn a profit of 30,000 rupees. But after his admission, these old partners are earning only 20,000 rupees. So, Naresh is sacrificing 30,000 rupees minus 20,000 rupees, 10,000 rupees towards Suresh. Ramesh is also sacrificing the same amount. Suresh is getting a benefit of 20,000 rupees. Instead of joining as a new partner in their firm, if Suresh starts his own business, can he earn this much of profit? No, because these two members have some reputation in the market. They struggled a lot. They developed the business, and on 1st April 2019, Suresh is coming as a new partner and equal to old partners. He is also getting profit. It is injustice to Naresh and Ramesh now. You may get one doubt. Suresh is bringing capital. Suresh brings capital, but capital is not the benefit for Naresh and Ramesh. Capital is invested in the business. If business develops, that profit belongs to all partners. But as Naresh and Ramesh are sacrificing 10,000 each towards new partner, they expect some extra benefit for this sacrification. That benefit is known as goodwill. So remember, when new partner is admitted in the partnership business, old partners have to sacrifice some portion of their profits to new partner. So for this sacrification, old partners demand some compensation from new partner. That compensation amount is known as goodwill. Which partnership firm can demand for goodwill? If partnership firm is able to earn super profits, if they have reputation in the market, then they can take some extra amount for goodwill from new partner. Goodwill adjustment methods. In case of admission, to adjust the goodwill, there are three methods: premium method, revaluation method, memorandum revaluation method. In question, he never mentions under which method we have to adjust the goodwill. So based on the goodwill related sentence, we should only identify which method is to be used to adjust the goodwill. When we have to adjust the goodwill under premium method, when new partner is bringing capital goodwill both in cash at the time of admission, then we should adjust this goodwill under premium method. Premium method is further divided into three methods: goodwill paid privately, goodwill is retained in the firm, goodwill is withdrawn by the old partners. So, in case of admission, to adjust the goodwill, finally there are five methods: premium A, premium B, premium C, second method, third method. In third problem, new partner Suresh is bringing 30,000 rupees capital and 15,000 rupees goodwill at the time of admission. As new partner is bringing capital, goodwill both, goodwill should be adjusted as per premium method. In premium method, three sub-methods are there, no? Which method is to be followed? In question, clearly he has given that Suresh has to bring this 15,000 rupees goodwill and the goodwill should be adjusted privately. So this is premium A, goodwill paid privately method. Under this method, the goodwill amount which is brought by new partner is taken by the Naresh and Ramesh according to their old profit and loss ratio. As goodwill is paid privately, no goodwill entries are made in the firm. Therefore, you need not to write any journal entry for this 15,000 rupees goodwill amount. New partner is bringing 30,000 rupees capital, no? Only for that capital we should write the entry. Adjustment number A. Suresh should bring 30,000 rupees as his capital. Let us see the journal entry for the capital brought by the new partner. For writing journal entry for capital, we should observe the old balance sheet asset side. Under asset side, whether cash in hand is given or cash at bank is given or both are given, we should observe. In third problem, under asset side, he has given cash at bank. He has not given cash in hand. Therefore, we should take bank account as one account. In the question, if cash in hand is given, then cash account we should take here. Suppose in old balance sheet under asset side, he has given cash balance, bank balance both. In that case also, cash account we should take here. As he has given only cash at bank, I am taking bank account as one account. And this capital is brought by Suresh now. Therefore, Suresh account is another account. Bank account with one organization name, when you open any account, it is a personal account. Suresh account with the person name we are opening this account now, it is also a personal account. Personal account rule: debit the receiver, credit the giver. Suresh is bringing 30,000 rupees cash by depositing that amount in firm's bank account. So banker is a receiver. Therefore, we should debit bank account. Suresh is giving 30,000 rupees to the firm. He is a giver. Therefore, we should credit Suresh account. Suresh is a partner. Means he is a owner. Owner's name we should not write in the books now. Instead of owner's name, we should write capital word. But if you write only capital word, there is no clarity regarding whose capital this is. As this is partnership firm, there are three partners. Therefore, instead of only writing capital word, I am writing Suresh capital account. Partner's name also we have to add to capital word. Then the final entry for bringing capital is bank account debtor to Suresh capital account. This is the last entry for bringing the capital into the firm. Bank account debtor to Suresh capital account. Suresh brought 30,000 rupees capital now. In amounts column mention that amount. Narration: being cash brought in by new partner towards his capital. We are preparing capital accounts now. In journal entry, capital account is credited. Therefore, this entry, credit side we have to post. In particulars column, what to write? Other side account name. We debited bank account now. Write down that account name. By bank account. And in Suresh amount column, we have to write 30,000 rupees. By bank account. In Suresh column, 30,000 rupees. With this, capital accounts posting is completed. We have taken the help of journal entries to post the transactions in capital accounts. Suppose journal entries are not asked in the question. Only ledger and balance sheet we are preparing. So in the absence of journal entries, how to prepare capital accounts? For that, we have to use these hints. Let us post the same transactions by using these hints. Partners brought capitals into the firm. If partners are retiring, firm should return these capitals to partners. Firm has to return the capital amounts to partners. Therefore, capitals are appearing on credit side. Similarly, in revaluation of assets and liabilities, there is a profit. In that profit, Naresh share and Ramesh share, firm should return to them if they return from the partnership. Therefore, credit side by revaluation account, these two amounts we are writing. Next, journal reserve. Partners' accumulated profits are in the firm. If partner is retiring, firm should return this money to them. Therefore, credit side we are writing by journal reserve. New partner brought capital into the firm. If new partner Suresh is retiring, firm should return this 30,000 rupees capital to him. So his capital credit side we are showing. In that manner also you can write the transactions in capital accounts. So after posting, next step in preparation of capital accounts is balancing. Only credit side we have amounts, debit side nothing. Therefore, credit totals become balance carried down amounts. Let us find out the totals of credit side amount columns. Same totals you have to show here as balance carried down. To balance carried down. Put the same totals here. In this manner, we have to prepare all the three partners' capital accounts in one table. Actually speaking, in ledger book, Naresh capital account separately we have to prepare. Ramesh capital account is a separate account and Suresh capital account is also a separate account. So instead of preparing three separate accounts, to save the time, three accounts details in one table only we are showing. After capital accounts, we have to prepare cash account or bank account. Now the doubt is which account we should prepare, either cash account or bank account. In old balance sheet under asset side, cash at bank 6,000 rupees given. Cash at bank means bank balance. Bank balance is 6,000 rupees. And in asset side, cash in hand is not given. Cash balance is not given, only bank balance is given. Therefore, bank account we are preparing. Suppose he has given cash in hand, he has not given bank balance in old balance sheet asset side. In that case, instead of bank account, you have to prepare cash account. Assume in old balance sheet under asset side, cash balance is available, bank balance is available. In that case, cash account we have to prepare. Bank balance as it is, you have to show that in new balance sheet under asset side. This bank account we have to start with the opening balance. From where you have to take this opening balance amount? In balance sheet under asset side, cash at bank 6,000 rupees is given now. That amount we should take. Opening balance, debit side we should show. To balance brought down 6,000 rupees. Why on debit side I am showing opening balance? Because cash at bank balance is an asset to the firm. Assets show debit balance. Therefore, opening balance debit side we have to show. Next, recollect the journal entries. Suresh brought capital now. What entry we wrote for that? Bank account debtor to Suresh capital account. We are preparing bank account now. So we should observe bank account is debited or credited in the journal entry. As bank account is debited in the journal entry, on debit side of bank account we have to post this entry. In particulars column what to write? Other side account name to Suresh capital and a name on column 30,000 rupees. To Suresh capital account. Suresh brought 30,000 rupees capital. Write down that amount. Then all journal entries related with the bank account we have posted. Finally, we have to do the balancing. As debit total is more, balance carried down appears on credit side. First, put the total here, 36,000 rupees. Same amount appears as balance carried down. In credit amount column also put the total. With this, ledger is completed. Under ledger we prepared revaluation account, capital accounts all the three partners and bank account. Now finally we have to show the balance sheet of all the three partners. Balance sheet of Naresh, Ramesh and Suresh as on 31st March 2019. As a new partner's name also we are including. This is new balance sheet. Liabilities amount, assets amount. As it is not an account, we should not put DR and CR symbols. With the help of old balance sheet, we have to prepare new balance sheet. First, let us start with the liabilities side. Creditors. You have to observe related with the creditors, any additional information is given or not. If any additional information is given, by considering that amount, we should show creditors value in the balance sheet. If there is no any additional information related to creditors, then creditors value as it is you have to show in your balance sheet. See the adjustments related with the creditors, there is no additional adjustment. Creditors. As there is no adjustment regarding creditors, write down 15,000 directly in amount column. Next one, bills payable 20,000 rupees. Related to this, there is one adjustment, EBIT. Bills payable need not be paid 2,000 rupees. Bills payable. As there is adjustment, show this 20,000 rupees in inner column. 2,000 rupees we need not to pay. We can consider this as a discount. Minus discount. 2,000 rupees. Net amount in outer column. In old balance sheet, general reserve amount is given at 21,000 rupees. General reserve amount already we have transferred to old partners capital accounts now. Therefore, it doesn't appear in new balance sheet under liability side. Next, you have to observe whether any extra liabilities are given in the adjustments. Extra liabilities are not given. So finally, we have to show the capitals of all the three partners here. Don't show old balance sheet capital amounts here. In capital accounts, we got balance carried on amounts now. These three amounts we have to show under liability side of new balance sheet as capitals of three partners. You can write three partners capital amounts in inner column you can put the total in outer column. Otherwise, directly you can write the amounts in outer column. I am directly writing in outer column. Naresh capital amount is 77,213 rupees. Ramesh capital is 38,607. Suresh capital is 30,000 rupees. Come to asset side, cash at bank 6,000 rupees. In new balance sheet asset side, as cash at bank, we should not write this 6,000 rupees. We prepared bank account now. In bank account, we got balance carried out 36,000 rupees. This amount we have to show as bank balance in new balance sheet under asset side. Cash at bank 36,000 rupees. Next one is bills receivable 10,000. Related with the bills receivable, there is no additional point. Therefore, bills receivable value 10,000 as it is, it appears in new balance sheet asset side. Bills receivables. As there is no adjustment, I am writing 10,000 rupees directly in amount column. Next one, debtors 21,000. In inner column, provision 1,000 rupees. In outer column, 20,000 rupees. And related with the debtors, adjustment number D. Provide for bad debts at the rate of 8% on debtors is given. Debtors. As there is adjustment, show the amount in inner column minus provision for bad debts. In revaluation account, we have calculated 8% on 21,000 rupees now. Total PBD should be 1680. That amount we have to deduct here. 19,320 rupees. Next one, stock 30,000 rupees. Related with stock, adjustment number B. Stock B depreciated by 5%. Stock. As there is adjustment, show the amount in inner column 30,000 rupees minus depreciation 1,500 rupees. In revaluation account on debit side we have calculated now. That amount you have to take here. Then the difference amount in amount column 28,500. Next one is investments 35,000 rupees. Investments means what? Don't think that partners invest money in the business, it is called investment. When partners bring money to start the business, that amount is known as capital. It appears under liability side. Investment means what? This partnership business has invested some amount in outside business. Maybe they invested in shares, debentures, or government bonds. That is known as investment. And related with investments, there is no additional point. Therefore, investments value 35,000 rupees as it is, we have to show in new balance sheet also. Investments 35,000 directly in amount column. Next one, machinery 45,000 rupees. In adjustments, machinery valued at 50,000 rupees is given. Machinery. As there is adjustment, show the balance sheet value in inner column and adjustment is 5,000 appreciation we have. Depreciation we have to deduct from asset value. Appreciation we should add to asset value. So plus appreciation in amount column total 50,000 rupees. Next you have to observe any extra assets are given in the adjustments. There are no extra assets in the adjustment. We have written all liabilities and assets in new balance sheet. Finally, we have to calculate the totals of these two amount columns. Liabilities amount column total is 1,78,820. Assets amount column total is same. So in balance sheet, two sides you should get the same total. Then only a problem is correct. In adjustments, he is giving that on 1st April 2019, Suresh was admitted into partnership for 1/6 share in profits of the business. You need not to consider this 1/6 share in any way of this problem. So this is all about problem number 3 from admission of a partner lesson. Hope this video is useful to you. Thank you.